everyone, it's Mauricio Rauld, and you're watching episode 5 of the Ask Mauricio Show, your weekly real estate syndication Q&A show. And last week, if you remember, I was letting you guys know that I was going to go pick up my little puppy, and here she is making her YouTube debut, Elsie. She's an English cream golden retriever, and she's 9 weeks old. So say hey, everyone. Anyway, today we've got a really special show because we're going to do all relating to funds. It's been a lot of questions about funds, and so I figured let's do an episode dedicated entirely to the subject. So without further ado, here we go, Courtney.
John asks, what happens if you raise money into your fund, but it takes a while for you to deploy those funds? Do you have to pay your investors a return while you hold the funds?
Great question, John, and not surprisingly, this is probably the most common question I get from syndicators who are thinking about putting together their first fund. Think about it. The last thing a syndicator wants to have is a bunch of cash in their operating account for 3, 6, 9 months while they're looking for property and having to provide their investors with some type of return. So this is something that's definitely a concern. And the way I explain this to clients is basically there's 4 ways you can look at it. The first one is to simply not take any money up front. Take soft commitments. This is typically a strategy that first-time syndicators want to do. They want to have the investor sign all the documents, sign all the offering documents, the PPM, the operating agreement, everything as you usually would, but instead of taking that $50,000 investment or $100,000 investment, you don't take it. And basically you go out and look for your property, and once you found the property, then you go back to your investor and say, okay, Mr. or Mrs. Investor, I found the deal, now please give me that 50K. The reason I don't usually recommend that is because a lot can happen between the time they make that commitment to the time you're ready to receive the cash. And I get it, there's a legally binding contract on all that fun stuff, but it's very common for investors to change their mind, especially the longer the time period goes. If it's 6 months or a year, or even 3 months, to be honest with you, between the time they commit and the time you're ready, they may have found a different investment that they just feel is better, or they just didn't want to wait that long, or maybe there's a family emergency. I mean, there's all these excuses, and I think the risk of waiting until you're ready to receive the money to actually receive it is a big mistake. So I would not recommend taking soft commitments. The second way that many syndicators do, which is actually my favorite, is to take a small percentage up front, sort of like a deposit. So same scenario, you start your fund, investors sign all the disclosure documents, the PPM, the operating agreement, subscription agreement, everything as they would in a normal syndication, but instead of giving you their entire, let's say it's a $100,000 investment, instead of giving you the entire $100,000, they just give you a percentage. Maybe it's 10% or 15% of that deposit as a deposit, and when you're ready to receive the rest of the monies, then you can do a cash call for the remaining 90%. If they fail to give you that cash call, then they forfeit that 10%. Okay, so as long as it's disclosed, that's what we can do. And so in that way, really, it's a disincentive for investors to back out, because now it's costing them 10% or 20% of whatever you think is enough to keep them on the hook. It's less likely for them to find a different investment because they're losing 10% if they were to renege on their commitment. So charging a deposit, or not charging a deposit, taking a deposit and then getting the rest of the money as a cash call with that forfeiture provision tends to keep them on the hook, and really the only times they really at that point are not going to go through with the investment if they truly have a medical emergency, or so something happened in their lives in between the time they made the commitment and when you need the cash, that you're most likely going to release them anyway. But that 10% deposit is probably the one that most of my clients use. Most of them use 10%. I've got a couple that use 20. Whatever you think is enough to keep them on the hook is what you should charge. The third thing you can do is over-raise so that you have enough money to pay them some kind of a holding cost. So for example, let's say you need $1 million in your fund. Well, you could raise 1.1 million and use that additional $100,000 to pay them some kind of a holding interest rate while you find the properties. This is something that syndicators like because it's a very easy thing to do. You over-raise and then you use that money to pay investors whatever their holding costs in, but many investors don't really like that. Even though it's okay to do because you're disclosing that in the offering doc, it's not something that most passive investors really like. You're basically paying them interest with money they've already given you, so it's sort of a return of capital, but it's definitely an option for you, and I do know some people that do take that route. The final way you can handle this is what I call the tough method, which essentially means, look, yes, you're not going to be receiving any returns in that time period that I'm finding the deal. So you're going to give me $100,000. And yes, it may sit in my account for 6 months, not earning a return for you. But you know what? It doesn't really matter, because if you look at the returns over the period of the fund, 4, 5, 6, 10 years, we're more than going to make up for it. And so even though you're not making money on the front end, it still makes sense for you to make the investment, because when all is said and done 5 years from now, you're going to be very, very happy with the returns. But that's a great question, John, and really appreciate you reaching out.
Jeremy asks, how different does your business plan or pitch deck need to be in a fund versus a project-specific syndication?
It's going to look completely different, because you don't actually have a property that you're raising capital for. So there's going to be no information about a particular property. There's going to be no pretty pictures. There's going to be no pro forma. There's going to be no use of funds. There's going to be no specific business plan in terms of your goal to improve the value of the property, like increasing the occupancy and increasing the rents. And none of that's going to be in your pitch deck like it would be in a project-specific syndication. On the blind fund, you're essentially going to have what we call fund criterias, which are the parameters that you're telling your investors of the type of deals you're going to go after. But you don't actually know the deals themselves, and so you're just giving them an idea. Maybe it's in this particular part of the country, this amount of units, this kind of leverage, and some examples of the types of properties you would give. So it's not uncommon in a pitch deck to show, either prior deals you've done, or just sometimes people just make them up so that at least the investor has an idea of the types of properties you're going to go after. But there really is nothing specific, which is why it's generally harder to raise money for a blind fund than it is for a project specific, because the investor can't actually look at your specific deal and challenge your assumptions, review your assumptions and challenge the assumptions. So the pitch deck is going to look completely different, but it is going to have your fund criteria, probably a section on, probably the most important section is going to be about you, the sponsor, and your experience, because that ultimately is what the investor is investing in.
Claire asks, how do you handle investors coming in and out of the fund? Can they come and go as they please?
Great question, Claire, and they absolutely should not be able to come in and out as they please. First and foremost, your bookkeeper would end up killing you, but more importantly, you don't want to have a situation where at any given time an investor can come in and just ask to have their money back and withdraw. You want to create what we call withdrawal windows, and so once you figure out what the minimum amount of time you want the investor to be in, let's just say it's a 2-year minimum or 3-year minimum, then after that you want to create a window, 1 or 2 months in that calendar year. Let's say, between August 1st and September 31st is when the investor has the opportunity to provide you notice with their intent to withdraw. That way, you're only dealing with the withdrawal windows once a year, and not only will your bookkeeper like you a lot more, it's going to be a lot easier to manage the investors coming in and out, not to mention not having to close the books every month or every week or every day if you're just letting people come in and out. Now, it's not uncommon for some funds to be a fixed period of time, just like a regular syndication. So there's nothing wrong with saying, look, this is a 5-year fund, a 7-year fund, and once you commit, you're in it for the entire time. But as you get to longer and longer funds, 10 or 15 or 20 years, or these evergreen funds, then your investors are probably not going to want to stay in for that long, and so you've got to give them an opportunity to withdraw and make a withdrawal request, and that's what these windows are for. Now you've got to figure out what the payout's going to be based on that withdrawal. So are you going to come up with some type of a formula where, maybe you do a net asset value evaluation of the fund, so you figure out what it's worth, and then you can give them a return based on that net asset value? Are you just going to give them a fixed return at that point, where if they want to get out prior to the end of the fund, you're going to give them their money back plus some percentage? Or sometimes people don't want you to get out, and so they kind of make it punitive for you to get out, meaning they allow you to get out, but they're only going to return your money, and so you're no longer eligible for all of the upside moving forward. But whatever structure you come up with, definitely make sure you have these windows of withdrawals. Now, one piece of advice that I see quite common is if you're going to have withdrawal windows, make sure that time that they're required to stay in isn't too long, because here's what happens. If you have a 10-year fund and you only have one withdrawal, let's say after 5 years, and if people don't get out after 5 years, they've got to stay in for another 5 years. Well, what tends to happen is when they get that opportunity to get out, they're going to get out because they don't want to get stuck for another 5 years. So you want to be careful about that, or cautious about that, making sure that once the withdrawal window starts, that there is kind of a periodic time for them to get out. Maybe it's once a year after they've satisfied that initial hold period, because otherwise you get that sort of rush to the exits that you want to avoid. One way to avoid that is to cap them, by the way. So if, for example, you are concerned that if the withdrawal windows opens up and your entire fund's going to come in and request a withdrawal, which may happen, by the way, if things aren't going well, one of the things we can do is cap the amount of withdrawals at any given time. So, for example, you could cap withdrawals at 25% of the entire fund. So if you have I'm just making this up, but if you have a $10 million fund, then maybe you cap withdrawals at any given time at $2.5 million. So if there's more than $2.5 million worth of requests for withdrawals, then you can just give them less of that money back, proportionately get it down. So at any given time, you're only out 25%. But by all means, make sure that you have withdrawal windows. Otherwise, you're going to run into situations where investors just want to come in and out of the fund at will, which is not a good idea. So great questions as always, and if you have any questions whatsoever, please drop them in the comments. I'm always looking for new questions to answer, so I'm happy to answer your question. Just drop it in the comments and we'll see you next week.